Understanding Islamic banking, principles, practices, and evolution. Islamic banking, also known as Islamic finance or Sharia-compliant finance, offers financial services in accordance with Islamic law or Sharia. This banking system, which emphasizes ethical and socially responsible investing, is distinct from conventional banking primarily due to its prohibition of interest, riba, and its emphasis on risk-sharing practices. Key principles of Islamic banking. Two of the fundamental tenets of Islamic banking are: 1. Profit and loss sharing. Islamic finance operates on a profit and loss sharing principle where profits and risks are shared among parties in a transaction. 2. Prohibition of interest. The collection and payment of interest are strictly forbidden in Islamic banking. Instead of earning interest, Islamic banks make profits through equity participation where a borrower shares a portion of their profits with the bank. Operational framework. In practice, Islamic banks operate through various modes of financing that comply with Sharia, employing principles of equity participation and risk sharing. Some common Islamic finance contracts include Murabaha, a cost-plus financing structure where the bank buys a product and sells it to the client at a marked-up price, allowing payments to be made in installments. Mudaraba, a partnership where one party provides capital while the other provides expertise and management. Profits are shared according to pre-agreed ratios, while losses are borne solely by the capital provider. Musharaka, a joint venture agreement where all partners contribute capital and share profits and losses based on equity participation. These systems allow banks to generate income without the conventional risks and ethical concerns associated with interest-based lending. Growth and global impact. The Islamic finance sector has witnessed significant growth over the past decade. As of 2021, the global Islamic finance market was valued at approximately $4 trillion and is projected to reach $5.9 trillion by 2026. This growth is largely attributed to the rise of economies in Muslim-majority countries, spurred by factors such as increasing oil prices, a growing middle class, and heightened awareness of ethical financial practices. Interestingly, Islamic financial assets have shown resilience even in challenging economic conditions. During the pandemic in 2020, Islamic banking assets grew by over 10%, highlighting the stability of this alternative finance model. Historical context of Islamic banking. The origins of Islamic banking can be traced back to the Middle Ages when Muslim traders engaged in financial transactions with European merchants. Initially, these traders employed interest-based banking similar to their European counterparts. However, as Islamic teachings became more deeply integrated into commerce, a shift towards interest-free financial models began. The modern revival of Islamic banking began in the 1960s. A notable early example is the MIT Gamar Savings Bank in Egypt, established in 1963 as the first contemporary Islamic bank. The bank utilized a profit-sharing model to lend money to businesses, emphasizing ethical lending practices. Although it ceased operations in 1967 due to political issues, it established a template for future Islamic financing. Since then, several Islamic banking institutions have emerged in various regions, including Europe, where conventional banks offer dedicated Islamic windows to cater to Muslim customers seeking Sharia-compliant services. Ethical investing and cultural relevance. Islamic banking is not just a financial system, it is deeply rooted in the Islamic ethos that prioritizes fairness, equity, and social justice. The prohibition of investment in certain industries, such as those associated with alcohol, gambling, and pork, aligns Islamic finance with socially responsible investing. This approach has attracted a diverse clientele beyond the Muslim community, as non-Muslims also see value in ethical finance. Differences from conventional banking. Comparatively, Islamic banking differs from conventional banking in several crucial ways. Speculation. Islamic banking prohibits mazir, or speculative practices. All financial transactions must have intrinsic value and involve tangible assets. Risk sharing. Islamic banks bear more risk compared to conventional lenders who primarily pass on risks to borrowers. Ethics and compliance. Transactions must be compliant with Sharia law, emphasizing ethical considerations in investment choices. Conclusion. Islamic banking presents a unique and robust alternative to traditional banking by prioritizing ethical practices, social justice, and community welfare. Its rapid growth reflects an increasing global recognition of the need for diverse and responsible financial systems that cater to the moral and ethical needs of society. As interest in ethical investing rises, the principles and practices of Islamic finance may play a pivotal role in shaping the future landscape of global finance.